Next guest is a senior portfolio manager and co-chair of the Fixed Income Policy Committee at Franklin Templeton. Mike Materasso joins us now in New York. Mike, good of you to join us. Just want to get your reaction to this comment, which also came through, that markets are less supportive of economic growth. How bad are things going to get?
Well, I think we've seen a bit of a soft patch in terms of economic data in the U.S., and I believe that today the FOMC release confirmed that. They talked about the fact that the markets, the credit markets aren't as supportive as they had been previously, primarily due to the problems in Europe. And also we have had some weaker data as it pertains to non-farm payroll, jobless claims, some of the retail sales data, as well as housing. And I think basically the Fed confirmed what we know already. And as you know, the markets reacted it was a very muted reaction to the statement because we believe that the markets had already priced that in.
Yeah, I mean, they're sanguine, you're saying it's priced in, but how much more can be priced in as well, especially if you look at the Treasury market?
Well, if you're asking me if interest rates can go lower, I believe that they can, but it will be based on further evidence of a weakening of the U.S. economy more than anything else. I think that'll definitely be the driver, and that remains to be seen. I think it's a little bit dangerous, though, to take, say, 1 month's worth of data, as I've mentioned, and to extrapolate that into the future and call it a trend. And I think it's far from that.
Yeah, Mike, but I wanted to look at that new home sales data because we have them at a record low, and it is one thing which was prevalent in previous months, which is not now, and that tax credit, that's been taken away. We see that 33,000, that fall that did take place. Now, tell me, surely we can read something into that. It shows that artificially we were getting a bit of a boost for the housing market, and that's not there anymore.
Well, we'll see with next month's data. But if you take the release today with last month's release and average them, the average is pretty much close to the trend that we've seen over the last several months. So we probably had an acceleration of purchases the previous month and then some give back this month. Obviously, though, when you see a 300,000 unit number, it does give you some concern. But I think you have to average the two, and it's not as bad as it seems.
Now, is there, well, in terms of the mood out there, do you think that's being reflected in what we're seeing in terms of yields?
Most definitely. I mean, we're at yields right now that we've only seen fleetingly over the last year. Keep in mind, a year ago, the 10-year Treasury was approaching 4%. We had a 4%, close to 4% level a couple of months ago, but since then we've declined pretty significantly. So the market.
Doesn't that worry you, Mike?
Doesn't it worry you that yields are as low as they are? I think it's reflective. I think it's reflective of some of the uncertainties that are at present, both in the U.S. as well as in Europe. But it also probably is a situation where you also have investors, certain types of investors that are flowing to U.S. assets, including Treasuries, and giving a bid to Treasuries. So I think it's a combination of factors. I'm not terribly worried. But it's definitely worth monitoring very closely, and that's what we're doing.
What do you make of what the Fed's been saying about Europe as well and the threat that poses to the U.S.? Do you think it poses a serious threat?
No, not really. As long as we don't have a systemic situation in Europe, if it's confined to providing financing for Greece and as well as fiscal constraint by most of the European countries, it probably just has a marginally negative effect on the U.S. growth, probably less than 0.5%, and we feel that that's pretty insignificant.
Mike Materasso, thank you so much for joining us there, just over there in New York. Mike Materasso from Franklin Templeton.